Have you ever wondered what happens to your super when you die? Will your spouse or children have to pay tax on it? In today's video, we'll look into superannuation strategies that can dramatically reduce the tax bill your beneficiaries face when you pass away. If you're nearing or in retirement, these tactics will help you preserve more of your nest egg for the people you care about most. We'll cover recontribution strategies, dual pension strategies, new rules since the 1st of July 2022, and death benefit nomination options. If you're new to the Retire Well project, welcome. My name is Rob Bourne, and I am a retired financial advisor with over 40 years' experience in taxation, superannuation, and maximising entitlements for the age pension. You've heard the saying about there are only two certain things in life, and that is death and taxes. While death is certain, taxes in super need not be. And in this video, I am going to show you how you can minimise or even eliminate taxes altogether. Let's start by looking at who you can leave your super to when you die, and what possible tax they might pay. When you pass away, your superannuation balance doesn't automatically go to your estate. You can actually nominate specific beneficiaries. But here's the catch. Who you choose as your beneficiary will influence how much, if any, tax they'll need to pay on your super payout. Broadly, your beneficiaries will fall into two groups for tax purposes. Tax dependents. This group includes your spouse or de facto partner, children under 18, anyone financially dependent on you, or someone you have an interdependency relationship with. The good news? If you leave your super to a tax dependent, any lump sum they receive is completely tax-free, regardless of how your super is made up. Non-tax dependents. Typically, this means your adult children or anyone else who doesn't fit the first group. If a non-tax dependent receives your super as a lump sum, the benefit is divided into two components. The tax-free component, which is always received tax-free, and the taxable component, which can be taxed at up to 17%, including the Medicare levy. What is the tax-free component of superannuation? When your superannuation balance is paid out, whether as a lump sum or death benefit, it gets split into two key parts, the taxable component and the tax-free component. The tax-free component is made up of contributions to your super that you've already paid tax on before you put them into super. These usually include non-concessional after-tax contributions, money you've put into super from your after-tax income. For example, voluntary personal contributions where you didn't claim a tax deduction. Certain government co-contributions or spouse contributions. These are also counted as tax-free. How is the tax-free component treated for tax purposes? If you take your super as a lump sum or income stream, the tax-free component is always tax-free, no matter your age. If your beneficiary receives your super when you die, the tax-free component is always tax-free, regardless of who receives it, spouse, children, friends, etc. So, there is never any tax payable on the tax-free component of a super benefit. What is the taxable component in superannuation? The taxable component is generally made up of contributions and earnings in your super fund that haven't already been taxed at your marginal tax rate. This usually includes employer contributions, including superannuation guarantee payments, salary sacrifice contributions, most personal deducted contributions, investment earnings in the fund. Although these contributions are taxed inside the superannuation fund at a concessional rate, usually 15%, they haven't been fully taxed as personal income. If this part of your super balance is paid to a tax dependent, e.g. your spouse, children under 18, someone financially dependent on you, the taxable component is received tax-free. If paid to a non-tax dependent, e.g. adult children, the taxable component may be taxed up to 15% plus Medicare levy, total of 17%. Example: suppose your super balance is $400,000 at death, with $100,000 as the tax-free component and $300,000 as the taxable component. If your spouse receives the benefit, no tax on either component. If your adult child receives the benefit, the tax-free component of $100,000 is also tax-free. But the taxable component, which is $300,000, will attract tax up to $51,000, i.e., 300,000 times 17%. Because non-tax dependents can lose a significant portion of their inheritance to tax, strategies that reduce the taxable component or increase the tax-free component can help your beneficiaries keep more of your super. The first one we will look at is called the Recontribution strategy. A recontribution strategy converts some or all of your super's taxable component into a tax-free component just before you start an income stream. This reduces the tax non-dependent beneficiaries pay on lump sum death benefits. Let's look at an example. Joe is 62 and single. He has an adult son. Joe has decided to retire in June and has $600,000 in his super fund made up entirely of employer contributions and investment earnings. His entire balance is therefore classed as a taxable component. Joe wants to start an income stream from his super, but before he does, he withdraws $480,000 as a tax-free lump sum and contributes $120,000 as a tax-free contribution back into his super. On the 1st of July, Joe makes another tax-free contribution of $360,000 by utilizing the bring forward rules, which allows him to contribute up to 3 times the tax-free contribution limit of $120,000. After making the contribution, Joe commences his income stream and both the tax-free and taxable components are locked in. Joe's components are now $480,000, tax-free or 80%, and $120,000 taxable, or 20%. Sadly, Joe passes away at age 68, and his super balance is $550,000. 80% or $440,000 is tax-free. The balance of $110,000 is a taxable component. His son would receive $531,300 after paying tax of 17% on the taxable component of $110,000. If Joe had not carried out the recontribution strategy, his son would pay 17% tax on $550,000, so the strategy has saved $74,800 in this example. The second strategy is called a dual pension strategy and is useful where you have a mix of beneficiaries. Again, let's look at an example to see how this works. Ken is married to Sue, and they have a daughter who is a single mother with 2 small children. Ken has $720,000 in super and wants to leave half of this to Sue and the other half to his daughter when he dies. All of his super is a taxable component. Ken is about to retire at 67, but before starting a pension from his super, he withdraws a lump sum tax-free of $360,000 and then contributes this amount into a second superannuation fund and commences 2 separate pensions from the 2 separate super funds. The original fund has a taxable component of $360,000 and he nominates Sue as the sole beneficiary using a binding death benefit nomination. The second pension fund also has $360,000, but this is a tax-free component, and Ken nominates his daughter as the beneficiary through a binding death benefit nomination. Again, the components are locked in at the time of starting each pension, so whatever the balances are on Ken's death will be. Pension 1. Taxable and paid to Sue, but as she is a dependent spouse, receives this tax-free. Pension 2. Tax-free and paid to Ken's daughter. Like the first strategy, this one makes use of the contribution strategy, allowed to increase the tax-free component. Had Ken not completed the recontribution strategy before commencing his pension, then his daughter would have paid 17% tax on the amount left to her. Even if you have no spouse and only 1 or more adult children, you can still use a dual strategy to preserve tax-free balance over time. You can do this by drawing only the minimum required each year from the 100% tax-free pension and drawing extra from the taxable pension to meet your living expenses. Over years, you preserve the tax-free bucket in Pension B. At death, the taxable pension is smaller, so less tax for your beneficiaries. Since the 1st of July 2022, the recontribution strategy has become more flexible. The work test has been removed, so you can now make personal contributions up to 28 days after turning 75. The bring forward rule has also been extended, and you can trigger a 3-year bring forward cap if you are under 75 at the start of the financial year. This flexibility allows you to recontribute larger sums over a longer period and even multiple recontribution cycles after retirement. If you already have a pension, you can still do the recontribution strategy, but you will need to commence a new pension with the funds you recontribute, as these cannot be added to an existing pension. If you fully withdraw the pension, then you first need to make sure you have drawn the minimum required income. This is better done late in the financial year to minimize any forced minimum withdrawals. Let's now look at the choices you have when nominating beneficiaries of your super fund. When you fill in the application form to start a pension, there will be a number of choices when it comes to nominating beneficiaries. If you intend to leave your super to your spouse, then you can choose a reversionary pension. This means your pension will continue to be paid to your spouse on your death. This may be a convenient way of ensuring no interruptions to your spouse's income. It does, however, have some possible downsides. The pension will now be counted under the assets and income test for your spouse. And while this may not have been a problem as a couple, your spouse will now be assessed under the single pensioner limits, which may impact your spouse's age pension if eligible. You cannot make a reversionary nomination to non-dependents like your adult children. You will also see on the pension application form the option to make a binding or non-lapsing nomination. This gives you the flexibility to nominate several people who are dependents for superannuation purposes. And the beneficiaries can generally choose, where eligible, to take a lump sum, pension, or both, where the fund's trust deed allows. You can also nominate to leave your super to your legal personal representative, LPR, which means your super will be dealt with by the person nominated to manage your will and estate. You would nominate your LPR where you want to leave part of your super to grandchildren, as they are not considered dependents under the Superannuation (SIS) legislation unless they fall into the interdependency definition, where they are reliant on the grandparents for their financial support. Siblings also fall under the same definition, and if they do not fall under the interdependence definition, then any death benefit nominations should be made to the LPR, who can then distribute funds through a valid will. It is also important, where applicable, to consider the impact of the transfer balance cap, which is the total amount you are allowed to have in a superannuation pension. While this will increase to $2 million from the 1st of July, 2025, nominating your spouse to receive your super may impact this if they are already near the limit. If you're approaching or in retirement, talk to your financial advisor or accountant about tailoring these strategies to your personal situation. A little planning today can save your loved ones thousands tomorrow. If you found this video helpful, please give it a thumbs up, subscribe, and hit the notification bell so you don't miss future super tips. Drop your questions below, and I'll do my best to answer them. Thanks for watching,